What was the industry growth rate?
Industry growth rate, Perry, is
7.07. This is historical, so
From
1926 to present.
And,
Actually, that was not the growth rate, that was the equity premium.
yeah. Do you know the industry growth rate?
no. Do you guys? No. Colton?
Do you guys have any detail on the comparable companies?
We do, just not on
Because
in there.
I'm just curious, the 50 million valuation comes out something like 10.8x 2017 EBITDA, which is very interesting. I don't know what pest control companies go for, but I feel like 10.8x is kind of high. That's just a guess.
There were some comparables that were much higher than that, and we kind of pulled out some of the outliers to get to where we got to.
What'd you say about the outliers?
They were like, there was one that was
20.
I want to say like 20.
It was, yeah, I think it was 40.
Yeah, that we pulled
And
out
it
the
made that,
outliers.
yeah.
So this is still relatively conservative.
Yeah.
Yeah,
For pest control companies?
for pest control companies.
And I would argue that, that Planet Friendly has somewhat of a premium on top of that, based on their, based on sort of them being an organic company that also has a higher profit margin due to the lower cost of goods, while also being able to charge a premium. And so I feel that the 6.76 is fairly reasonable in that sense. Yes.
So when you're doing that forward-looking multiple, early on you mentioned that they were looking at acquiring 2 more companies.
Mhm.
Is that the EBITDA that you're applying that forward-looking multiple to, is that post-acquisition of those 2 companies?
Yes.
So how did you account for the purchase price of those companies?
So, well, this purchase price, because like as mentioned, the company is still in the stage of search list companies, and they're acquiring 2 relatively much more smaller firms to attribute to this company's growth. That's why if you take a look at the growth projection over the 5 years, there is a much like huge jump over the next 5 years. So we don't think we would worry too much about acquiring 2 firms when taken. We wouldn't looking at the multiple.
Yeah, but that doesn't really approach Jeff's question about how did you deal with the capital they had to expend to get that growth?
So for the FMM model, we just use the free cash flow projections that were provided by Gene. He didn't, because of certain disclosures that he could tell us, we didn't really get some info on the companies that he was planning to acquire. He said that he was very close to acquiring a smaller company, and then there was the highly likelihood of acquiring a second in the next year. We didn't really get much information on those companies, but the projections are based off of the ones that Gene provided, based off of what he believes those 2 firms will add to the company.
Yeah, so I think you're making my point for me. You've done a discounted cash flow based on those projections. You've looked at a forward-looking multiple based on those projections, but you haven't subtracted out the cost to acquire those businesses. Right? So
Sure.
I'm going to have $1 million in free cash flow next year, and at a forward-looking multiple of 5 times, that's worth $5 million. I don't own it today. What's that worth to me?
Oh, I can help with this, I apologize. These are largely going to be financed from internal resources, and his free cash flow figures already consider the change in his, it considers his net capital spending and change in net working capital.
Okay,
Yeah, it's in there.
Purchase price
baked in.
They're
The
baked
purchase
in.
price is baked
His
in.
free cash flow numbers, that's baked in.
Okay, I'm still not sure that gets us there on the forward-looking multiple.
Okay.
I mean, in the sense that the forward-looking multiple, if you're going to go out and acquire a business, you have to include that somewhere in your spend.
Mhm.
And I don't think I think it's an apples and oranges comparison to take forward-looking cash flow and a forward-looking multiple to get to a number when we haven't actually spent the capital yet.
So, and this is just a pure curiosity, if you do an explicit periods discounted cash flow that includes the acquisition period and don't apply the multiple until after that, have you resolved that issue or have you compounded it?
So, being brutally honest,
Yeah.
I would never, if I'm gonna be acquiring a business, you're gonna have to pay fair market value for it. By definition, fair market value is the present value of future cash flows. I wouldn't actually include that in my cash flow projection, or in my market flow projection.
Okay?
I would value it without that assumption. Yes, so I would include cash flows that don't include the acquisition, don't include the benefit of the acquisition, and don't include the spend.
Okay.
Interesting. Thank you.
And Can you go back to your discount rate calculation? Yeah. So this looks like cost of equity. Am I right? Kind of cost of equity?
Yep.
Cost of capital.
Is the debt on their books, the cost of their debt baked into this in any way? I'm not too familiar with Duff and Phelps still, but just wondering because this looks like an equity construction, and there's nothing to be said about the cost of debt, which they have 11.8 million on their books.
Looking
It's
at the
costing them
balance
something.
sheet and the interest expenses that have occurred, the debt's about 7-something%. So it's not baked into this. This is, you're right, this is an equity calculation, cost of capital.
So would you use the Duff and Phelps estimator for cost of equity, some measure you already have for cost of debt, and come up with a cost of capital through that?
We felt that it was more necessary to do something from a buyer's perspective rather than a weighted average cost of capital perspective. So we figured giving it a higher R would make a little bit more sense.
Can you explain that to me? Why does a
Yeah.
buyer's perspective push us to a cost of equity capital?
Looking at it as if you're going to acquire the entire company, you're going to want that return for yourself. And so,
Yeah, but you also assume that debt.
Yeah, you're
Sure.
missing his point.
Yeah.
If I buy the company, I buy the debt.
yeah,
Or the debt gets paid off and then I can go get my own debt and reduce my cost of
Right.
sure.
So generally speaking, if you're gonna do if you're valuing cash flow to all debt holders, all stakeholders, meaning you haven't made any adjustments for debt, you've gotta use a cost of capital.
Okay.
So that's gonna be a weighted average cost of
Mhm.
capital. If you're gonna do just cost of equity, you have to change your cash flows so that you're including all of the principal repayments on that debt, as well as the interest expense on it.
Okay.
And rule of thumb, I can count on one hand the number of times I've used cost of equity capital.
Equity only, right?
Equity only.
Yeah.
Now, every project, you determine the cost of equity.
Can I ask you a question then?
Please.
So, like last time that we did the presentations, we kind of had higher Rs at like 25%, let's say. That's not taking into consideration WACC, or weighted average cost of capital. How would you interpret that?
So I would always, I mean, again, with a very few limited exceptions that would primarily be focused on the nature of the industry of the company I'm valuing, I'm almost always going to use a weighted average cost of capital. So I'm going to use a build-up method, a capital asset pricing model. I'll
Okay.
use the Duff and Phelps calculated, whatever, calculated cost of equity. And then I'm going to look at the company's, I might look at the company's actual cost of debt. If for some reason I think that's not reasonable, I'd probably just do like a BAA bond
Okay.
to come up with the cost of debt. And then I'll weight them. Now, pop quiz, when you weight them, what capital structure do you use? Or how do you determine the capital structure?
I'm not sure I even understand the question you just asked.
So when you weight them, how do you determine the debt weighting and the
Based
equity
upon
weighting?
size, or based upon how much debt versus equity you have in the company?
Yeah, but
Proportion.
proportion, okay, debt to equity. The debt we can tell from the balance sheet. How do we determine the equity amount? Share price,
Dividends.
okay, for a private company, what's its share price? What's it trading at? You don't
No
know,
idea.
so how do you determine it?
Did have preferred dividends, and then it also had some payouts as well.
That's still,
How do you determine that? That's still doesn't give me
I
my
don't know
final
that
answer.
answer.
So there are two ways to do it. One is iterative.
Okay.
You have to, it's this big circle where you say, okay, what's my weighting? What value does that, what's my weighting? What whack does that give me? When I plug that whack into my discounted cash flow, what value does that give me? What weighting does that, what debt to equity weighting does that value imply, and how does that compare? And you gotta keep changing that until it all, that circle flows.
Think of it like an extrapolation,
Okay.
same way IRR is calculated.
Yeah.
Yeah,
So that's one way.
We just do, we've got smarter people than me, we just programmed it into Excel, and I've got a button I push, and it just iterates it until I get the right number. The other thing you can do is use an industry capital structure, which I'll usually do by looking at the public comps
Mhm.
and say what's their debt, what's their equity as a percentage of total capital.
Okay. So you would prefer to do a calculation of that rather than using that in the model rather than using a required rate of return from an investor standpoint?
Well, the required rate of return from the investors, I mean, I think those are one and the same, right?
Sure, but like,
There's a cost of equity capital, and then there's a cost of debt capital. If we're valuing the entire company, then we would look at a cost of capital
Okay.
for
Okay.
debt and equity, a
Sure.
weighted average cost of capital. If I'm valuing the equity, what I'll actually do is I'll value the entire enterprise using the weighted
Mhm.
average cost of capital, subtract off the debt,
gotcha,
and then that
And then
gives me the equity piece.
gotcha, okay. Thank you.
So did you understand the circularity of the logic that he was at first trying to help you see through?
Mhm.
Okay. So the iterative element in his spreadsheets is the what if function in Excel probably, or some variation
Yeah, I
on
mean,
it.
it's,
How to make a macro for it?
Yeah.
we've got a macro for it,
Yeah.
but it's effectively that.
Yeah,
It's effectively.
yeah. So it's going to
Uh,
extrapolate.
Cool.
So, go ahead, no, go ahead.
Just a quick question. So this might not be the debt equity question we just talked about, but when we were doing this Duff and Phelps calculation, it asks us to provide the revenue and EBIT over the historical revenue and EBIT,
Yep.
and how is that contributing to calculating the cost of equity in this case?
Yeah, so what Duff and Phelps has done
Mhm.
is they've gone through and analyzed the market. They go back to, so there's two data sources. There's one that goes back to 26, I think it was 29, but it could have been 26. That's what I call the Ibbetson's data. It's now all been merged into Duff and Phelps in the last couple
Okay.
of years. But there are two different data sources. So there's the old Ibbetsons. The Ibbetsons are the CRISP, I can't think of that, it stands for Chicago or something. The CRISP data, and then there's the legacy Duff and Phelps data that goes back to the mid-60s, and they look at the return. But essentially what they're doing is they're going back over time and figuring out the correlation between revenue and return, EBIT and return. And so when you're plugging in these metrics, like the Duff and Phelps, it's truly a regression equation. And you can actually, you can find the equation and just plug the metrics into the equation, and it'll tell you exactly what's the cost of equity capital for a company with an average revenue of $1 million for the last 5 years, an average EBITDA, and it'll give you all these different data points.
Okay.
And sometimes you can use, again, there are, I mean, literally, there was a cost of capital presentation, that fortunately one of my colleagues attended and not me, and they walked through the 46 different ways you can calculate cost of equity capital using the Duff and Phelps calculator. And that sounds like torture.
I'll put something sharp in my eye.
Yeah, I can't think of much worse than that. And, so you can use Duff and Phelps, it breaks it out into 25 different deciles. And so you can use the specific decile, or I say decile, it can't be decile, 25 different groupings. And so for a company with this average revenue size, it might be in the 24th grouping or the 25th grouping. Or you can use the regression equation, and again, they've got, and if you read the Duff and Phelps book, I think they've got 8 different tables that you can use, each with 7 different metrics. I mean, it's ridiculous.
So it simply is used to control for size and comparable, if you will.
Got it.
Whatever works for you.
Yeah.
That's right.
And that's what, when we look at these things, I don't get too hung up on, In fact, I would have rounded that. I wouldn't have put 15.32%. I would have said, so
15.
we concluded it's 15%.
Okay.
What I get hung up on is, does that really make sense? And my critique of this is I think your discount rate's a little low.
Yeah.
I mean, particularly given that there's a cost of equity. That actually might even out. If you would have done a weighted average cost of capital, you could end up back at that 15%.
Well, if that's the discount rate based on equity alone, and the debt capital has a lower rate, then that's actually high.
That's actually high, but what you're missing here, so if we think about cost of capital in general, what we're taught in school is that it's to mimic, an investor's required return, okay? What isn't so clear, and Rick alluded to this on our very first class, is that there's a relationship between, there's obviously a relationship between your cost of capital and, and the business, the industry, that sort of thing. But there's also a relationship between that and the projections. And you've got pretty aggressive growth projections, and so I would expect to jack that thing up to reflect that, because I think there's a lot of risk in those projections. If you were giving me riskless, we'll say, I'm not sure there is such a thing, but riskless projections, then I would say there's no specific risk you can get. But the valuation literature for privately held companies will say you ought to add specific company risk, or you ought to at least consider adding specific company risk. Now, what do practitioners add? Anyone want to guess what typical ranges are for specific company risk?
I have no idea.
I mean, it's all over the board. I try to avoid adding specific company risk. I try to adjust my projections to get to a number where I go, I think these projections are good, I'm not going to add specific risk. There are a lot of practitioners that'll add 2 or 3% specific company risk without even batting out. And then there are others that'll add 5, 6, 7% specific company risk. You start thinking about it in terms of cost of debt.
And these are absolute points, not proportional, right?
Yeah, I mean, that's
Yeah.
why you're adding 500 basis points.
Right. So doesn't the Duff and Phelps calculator include a variable for specific company risk? Or am I not remembering that correctly?
So
They
when
do,
you
yeah.
say variable, I now, full disclosure, I have never used the Duff and Phelps.
I think it has a field that lets you
It's got a
put
field
in
that lets
that
you put it.
value.
I would fully expect.
Yeah.
Yes.
Yeah.
Yes.
Okay.
I actually printed off the Duff and Phelps because it was a particularly curious experience. I have a question for you though, Jeff. When you're talking about risk, one of the things that seemed pretty evident with the kind of work that they're doing is that their customers and the services that they're offering are not viewed as discretionary. Gene told us that people are taking their vacation savings and putting it into a remediation service that's going to cost 14 grand or something like that. So these are not seen as discretionary expenses, and so that kind of told us that there's not no risk, but
Yeah. So that would certainly reduce the risk, but it also you've got the competitive forces at play, right? I mean, and I don't know that industry. How difficult is it for me to go buy a truck and I mean,
You get your license and
I know the industry well enough to know they call them chuck in a truck.
yeah.
And you go buy a truck, you throw some stuff in there, and you go spray. And so you got competitive forces at play here. The other thing I'm curious about, that's somewhat related to that, you used the SIC code you used. I think you said was business services.
Yeah, the most that we could narrow it down in Duff and Phelps was 7.3. Even though we know that the 7342 is specifically pesticides.
Yeah, and what that means is there aren't any publicly traded pesticide companies, or there aren't enough to get there. So,
Yeah.
so Duff and Phelps will take you up to the level where you've got a concentration of companies. And so, you know, if you can't get down to that 7342, it's because there aren't any or aren't enough publicly traded companies to get there. How much of their business is providing pest control to businesses versus individual homes?
Most, it's cyclical. Most of it is residential, but in the wintertime, they tend to do more commercial
Well, wasn't it
space.
like in the 30% or more range of their total revenue? Wasn't their commercial application?
Commercial was 30?
Wasn't it something like that?
Yeah, something,
So
yeah.
not trivial.
Yes, so what I would expect to, I mean, so you put 100%, by using that SIC code, you put 100% on providing services to businesses and 0% providing to individual residences. There's another SIC code for personal services. Now, I mean, to your point, you looked up pest control and 7342, and so you just went up to 73. But if you're gonna use business services, I would also think about looking at personal services. It just seems
Okay.
different there. Last comment, what's the tax rate in Maryland? You knew that was coming.
Okay,
Yeah,
I'm gonna own this. I'm gonna own this.
When you
So-
said that earlier.
Yeah. So in the courses that they've taken where we've done this, I've given them a federal tax calculator.
Yep.
And disclaimed that the reason I haven't done state tax calculations because they're all different, but told them, don't forget that they're state tax calculations, okay? But I'm gonna own
Take
this
blame
one
for that.
because I probably said it one time.
So I just looked it up, it's 8.25%.
Okay.
So it's pretty
Not
sizable.
29% essentially, yeah.
Sorry, can I ask one more question?
Please.
Go to your second to last slide where you show the valuation. This one, key value drivers, I have never heard of that in my life. Can someone explain that methodology to me?
So McKinsey's KVD formation of a continuation term?
Okay, and then what is that?
KVD is key value driver. So wherein or in free cash flow, where we normally think of it as I call no plat. So EBIT times 1 minus the tax rate,
Okay.
plus depreciation, plus minus change in net capital spending, minus change in net working capital. So in McKinsey's formation is an alternative. It is the same EBIT times 1 minus the tax rate times 1 minus G divided by ROIC.
Okay.
And those include the key value drivers and are the algebraic building blocks of a multiple.
And so essentially, the reason that one's so much lower is because you don't have as much growth in there.
Exactly.
You're-
And that's the difference between those, right?
Yeah.
And so, from a presentation standpoint, this is one of my big pet peeves that I see in a lot of valuations, where it's somewhere between, and yours isn't bad, being brutally honest. I've seen huge disparities, but you're saying it's somewhere between 45 and 54 million dollars,
Yeah.
and we've weighted them all equally. I wouldn't put any weight in that keyword. In fact, I wouldn't even display the key value.
Okay.
Because if you're
Just
sitting-
wait, these two.
Yeah, well, and the reason for that, so I would look at this, as a preliminary answer, I'd
Yeah.
look at that and say, okay, boy, I'm getting different numbers here, why am I getting such different numbers? And the answer to that is, well, my key value driver doesn't have the short-term growth that we're projecting. And so by definition, that's not the right model to use for this business. Now, it might be the right model to use if we want to figure out how much is really coming from that growth. And in other contexts, it might be the model to use. But here, you've weighted them equally when we know there's a flaw with that model in this context because we don't have the growth. It's not modeled.
Well, to come back to a comment you made 2 weeks ago, if your valuations are more than 10% apart, you're going to try and reconcile why and figure out why you have a problem. We're more than 10%
Yeah.
apart.
That's my rule of thumb. You
Right.
can never find that in the textbook, but that's my rule of thumb.
Okay.
So in this case, the KVD is just bound to give rise to more questions than it's going to answer, and so just get rid of it, is that what you're saying? In terms of.
In terms of
presentation?
in terms
Yeah, I
of
mean,
presenting.
What I would say is this, I think it's absolutely appropriate to use, and I would strongly encourage using as many valuation models as make sense, or methods as make sense. When you do that, you're gonna get a range of answers, and so I want you to look at those answers and say, okay, why am I getting this range? Do I have an assumption, do I have an inconsistent assumption, here? Are all my assumptions in my DCF model reasonable and appropriate? Are the comps that I've selected truly comparable, or are they not comparable? Do I need to make some adjustments to them? And analyze, go back and check and recheck and test and retest every assumption you've made. Once you've done that, you'll end up naturally getting closer together. And then you sit back and you say, okay, well, does this make sense? And the way I advise you to see if it makes sense is, when we're talking $50 million, I can't wrap my arms around that because I don't have $50 million to put into a company. But translate it down to, $50, $500, or something that you can relate to. Say, okay, would I be willing to pay $500 for something that's going to give me $1 every year? That I can wrap my arms around, and no,
Yeah.
there's no way I would.
Okay.
So I would do that to see if it makes sense. And then the other thing I would do is if I can't get close on my numbers, and if I come up with a good reason why I can't get close, I just mix it.
Okay.
how would you use that KVD structure and get close?
We could look at the growth that's affecting it and
Could we use the free cash flow model's value and the KVD structure and reverse engineer the long-term growth rate? And
Yes.
then consider whether or not we think there's any likelihood that it's accurate or reasonable.
Gotcha.
And if it is, cool, we're gonna use it, and if
Yeah,
it's not,
and in this case, it's probably not.
in this case, it may not be. Okay.
So in this QVD model, the cash flow we use is not no plus free cash flow, but we still get a big difference.
I'm sorry. So in the KVD model, in the continuation form, you use free cash flow instead of no plat?
No, not the continuation.
In the DCF portion?
Yes.
Yeah, sure, right.
Yeah.
Okay. Okay, so again, meaningfully improved from last time, honestly, in a bunch of different ways, okay? So beyond that, what did you guys learn over the last couple of weeks in dealing with this that you didn't know prior? That you didn't know when you did your first presentation 2 weeks ago?
We learned how to better organize
Okay.
presentation and figure out a better flow of what we wanted to touch on, and including only stuff that we wanted to actually elaborate on and better tell the story.
Okay, what about the other team?
I think really backing up our numbers with the story and reasonable numbers and
Okay.
cross-checking.
And for me, you might be a third of the way or so there, maybe halfway in the story. Maybe something, maybe we have a ways to go with,
Yeah.
for the story. Okay, but we knew that, right? What else?
I think the evaluation we did before, at least in Finance 309 class, is mostly public companies. And valuing a private company is much more different. Like for industry analysis, finding the comps, and I think we still have room to improve
Lots
on that. Yeah.
Well, and moreover, the cases that we've done in 309, 409, if you will, we didn't go out and get a lot of comps, right? It was stuff that was being fed to you.
Yeah.
So, sure. So how do you think you're doing in your groups, your teams, in terms of identifying who should do what? What's your division of labor like? So, Val, in your team, who did what? Who was assigned to do what part of the labor for this?
So Chara and Louise were doing the financials. Oscar and myself were doing the multiples, but he took the handle of that. We were trying to get it to Pittsburgh, and it was a struggle.
Yep.
Yeah.
So when you say the multiples, you mean the comps to find multiples?
Yeah.
Thank you.
Yeah, and then we have Mike working on the industry analysis along with Grace.
Okay. So I'm going to argue that one of you simply needs to be the artist. One of you needs to take out your creative writing pen and figure out how to tell this story the very bestest way possible. And go find Nancy Panos Schmidt. Right? If there's anybody in this joint that can weave a story, it's the Greek upstairs. Or downstairs, wherever she is, right? Oh, I'm telling you now. Okay? So step outside of yourselves, outside of Jeff, myself, whomever else we've got assigned to us, and pull in other resources. Okay? Give these guys a hand. You did a great job.